Hello, everyone, and thank you for taking time out of your busy day to join us for the call. We promise not to waste it. Just a couple things before we hand the show over to our guest speaker today. We will have the lines muted for the call, so if you have any questions, you'll notice that there is a chat feature in your control panel. Feel free to either enter them in there, and I will be watching these as our guest speaker is speaking, so I'll try to handle them there. If not, you can save them to the end. We will make sure to have our phone number listed many times throughout the show today, so that way you'll know how to get a hold of us. So feel free. Any questions you have, let us know. The other thing today, we are going to be focusing on usable sales content. Many of you are aware that we're spending a lot of money on leads, and our clients are referring over people they trust, so having quality content while you're speaking with your clients is of the utmost importance. Many times when we talk with agents out in the field, we ask them what kind of business they are writing. A lot of times they say, well, we're just writing term. Our clients aren't asking us for any of the other kind of products like whole life or universal life. And what you're going to see as you start listening to our speaker today is that those kind of sales aren't just made by accident. You really do need to understand quality content and ways to guide conversation to get into those products that are more suitable for your clients, especially when we're talking about cash value life. With that being said, I'm going to pass this over to Seth Groff. He's the manager of the life division at Assurity, very passionate about participating whole life and what it can do for families today. With that being said, Seth, the show is now yours. Go ahead.
All right. Well, thanks, Jason. And I'm going to share my screen here. And the presentation should be up and going. And I'd like to thank everybody as well for taking a little bit of time today to learn a little bit more about how a maximum funded participating whole life policy can really help Middle America achieve their financial goals. You know, as Jason said, I am passionate about participating whole life. And, you know, I believe that everyone, regardless of, you know, if they're middle income, upper income, regardless, I believe they should have some participating whole life in their portfolio. And, you know, there's several reasons for that, but the reality is that if you go out onto the street and you ask 10 people, if they want to buy a participating whole life plan, they're going to say no. You know, it's just when they wake up in the morning, their number one financial priority is not to buy a life insurance plan, and if it is to buy a life insurance plan, it's probably not a whole life policy. So I've recognized that fact, and what I've done is I've looked for ways that I can structure a participating whole life plan to essentially help them achieve their financial goals. So, you know, when you look in the industry, and if you've been in the industry a long time, there's a lot of different selling systems out there to accomplish this. Maybe you've heard of Infinite Banking, Circle Wealth. There's several out there. What this is this is a general concept using some of those same strategies to accomplish the same thing. So that's really what we're going to talk about here today. But the good news is that, you know, these strategies, and as Jason said, you know, if you use these concepts and you go out and apply them, you might not make as many sales, but you're going to make bigger sales. And using these concepts, it's not uncommon here at Assurity to get $500 a month, $1,000 a month, or even more premiums. So these do result in bigger cases, but you kind of have to have a different mindset, and you have to look at where you're getting the money from the client. You know, most people, when they sell term insurance, they're trying to take money out of their lifestyle, right? They're trying to say, okay, well, can you afford $20 a month in your current budget? That's fine, but it's going to result in a small term sale. If you want to sell more whole life or universal life or just cash value insurance in general, you have to be able to show them how you can help them achieve their financial goals, because they're probably putting money away somewhere else to achieve these financial goals. And if you can show them how life insurance can help them achieve those goals while at the same time protecting the risk of a premature death with the life insurance death benefit, you're going to be able to make more sales. So that's kind of what we're going to talk about today. Kind of go through just the overall concept of it. Then at the end, I have a series of questions that I normally ask when I'm talking to a potential client about using this concept. So that's really what we're going to cover today. But here's what you have to think about. When I say using life insurance to achieve a financial goal or fund a major purchase, I always stop and I say, okay, how many people plan on dying in the next 20 years? And I ask this a lot of times when I'm giving this presentation, and everybody laughs. But the reality is, unless you're talking to a group of seniors 80 and above, most people don't plan on dying in the next 20 years. So then why is so much 20-year term insurance sold? I mean, it serves a purpose, it serves a need, but the reality is that, and I'm not saying don't sell it, because people that need the life insurance, but what I try to help people realize is that we're selling term insurance to people, and chances are they're not going to use it. But how many people plan on purchasing something over $10,000 in the next 20 years? And everybody, if they're a hardworking individual, is probably going to purchase something $10,000 or more in the next 20 years. It might be a car, it might be a house, whatever the case might be. People purchase things more than $10,000 in the next 20 years, and then the question you have to ask is, how are they planning on financing it? Are they looking at going to the bank? Are they looking at saving it? What options do they have, and are they actually utilizing the best options that they have at their disposal? So this is the mindset that you have to have, is that we sell term insurance that they probably won't use, but if we can show them how they can use their permanent policy for something that they know they're going to do in the next 20 years, they're going to be a lot more likely to buy it. So, when you use whole life or cash value life insurance to do these strategies, the one thing that I have to kind of point out, and sometimes agents get real passionate about it, and they say, oh, you're doing it wrong, you're doing it wrong. Well, that's not a good way to approach the client. They're probably using some of these strategies that that might not be as good as whole life. And so I always have to kind of slow agents down, and you can't talk trash, so to speak, about the strategies that the individual is using, because you're basically telling them that they've been doing it wrong, and then they're going to become skeptical and not want to work with you. But the simple questions that I ask is, if there's a better way to accumulate wealth, when would you want to know about it? And make sure they know that with the information that they have been given, they've done really well, but there might be a better way. And so this is kind of the question that I use to open up the concept, because it is going to be new to a lot of people. A lot of people are going to say, wow, I didn't know life insurance could do that, or are you sure this is life insurance? But the reality is it is. So you have to be tactful when going in and starting conversations about this with your client. So the whole concept that we're going to talk about is essentially accessing the cash value of a plan to fund a major purchase, and we're going to look at an example here. But before we get into that, you have to understand the flow of money, and you have to understand banking and why it exists. Our society lives where we need what we want now. We want a house now, we don't save up for it, right? We take out a mortgage. We want a car now, we don't save up for it, we go out and take an auto loan. Essentially, the banks exist because we want things now, right? And so we go and we need the money, we take a loan and we get it. That's the human nature, that's the way it is. There's it's the flow of money, there's essentially a set amount of money, unless the government's printing more money. You have to understand that concept, that from a society, we want it now. And you kind of have to overcome this thinking if you're going to use life insurance, because essentially we have to set it up so that we have an alternative to going down to the bank. But with the banks, it's all about leverage. And here's what I mean. Leverage is all about using someone else's money for your gain. And if you think about how a bank operates, how does it operate? It goes out first. Well, first of all, it has, a lot of assets, right? But then it goes out and it gets depositors, right? It goes out and gets people like you and me to go put money into their bank. And in order for us to put the money into the bank, they have, they have to pay us an interest, right? But then they get access to our money. While they're paying us an interest, they take our money and loan it out to other individuals that want to go out and buy something. But when they loan it out, they don't loan it out at the same interest rate that they're paying us. They loan it out at a greater interest rate. And basically then what do is they operate on the spread. And so you have to understand that, and why this makes sense about building up the cash value in a life insurance plan, borrowing against it and paying it back, is because you're going to essentially become that entity where you can take a loan out and pay it back and get a spread on what you're paying. And so you're going to be able to recapture that spread that you're paying out to pay, or that you're, I guess, not paying out, but that the bank is taking from you by leveraging your money to give it to someone else. Well, let's see if we can set up the same sort of strategy with a life insurance plan. And what you have to realize is that we do finance everything we buy, right? First, what we start doing is we go and we take a loan, and then we're in debt, and then we work our entire lives to get out of debt. And eventually we might get out of debt, and then we say, you know what, next time, this next car that I'm going to sell, I'm going to save up and go out. I'm going to save up before I go out and buy the car. And so we save, and we get enough money to go buy that car, and then what happens is we drain that tank. And so you're either going out and borrowing from the bank and you're losing interest costs, or you're saving up money and then draining that tank, and so you're losing opportunity costs. And so whether you're losing opportunity costs or interest, the bottom line is you have to realize that we finance everything we buy, and traditionally those are the two ways people look at to finance items. You know, either go out, take a loan, or save up and then drain the tank. But what I'm going to show you is a way that we can prevent having to pay interest to somebody else and recapture some of that opportunity cost in a life insurance plan. And so that's what we're going to talk about. And what we're going to do, how we're going to accomplish this, is we're going to utilize a participating whole life plan to do this. And basically the way that we set this up is we set it up so that we maximize the cash value and we minimize the death benefit. And at Assurity, we actually have a solve that allows you to do that. So it allows you to get a premium commitment, and then it's going to determine the best ratio of base death benefit and cash to maximize cash value. Now, obviously, when we're setting this up, we want to get as close to that MEC line as possible to maximize the cash, but we don't want to cross it. Also, you want to make sure you're working with a participating whole life plan that earns dividends, and that you're working with a mutual company. It just so happens that those 4 bullet points Assurity can provide for all you guys on the call today. So Assurity Mutual Company, long history with our participating whole life plan, paying dividends over 120 years, so long history of it, so we're a great fit for that. But when you go out to talk to a client about this and this strategy, what you have to do is you have to talk to them about a place where they're either losing interest or opportunity costs. And so the easiest way to do this is I use purchasing a car. You know, so I say, okay, you know, let's assume you're going to purchase a car every 5 years for 20 years. So you basically purchase 4 cars, right? And you're going to spend $20,000 each year on the car. And so your options, obviously, are that you can go out and lease the car. The downside to leasing the car is at the end of the 20 years, you have no car. You have no equity. You paid into it, and you know, there might be some buy options, but then you're in the purchase of just buying a car. So this isn't necessarily the best strategy to go out and get a car. Probably the most common strategy that you see people is that they go out and take a loan, right? So if we go out and take a loan for at 5% interest, our monthly payment is going to be $377, or you know, $4,500 a month, or excuse me, a year. At the end of it, you know, we paid $90,580. We received $80,000, so we paid $10,580 on that loan. You know, if you consider the 4 loans that we take out, right? Remember, we're taking 4 $20,000 loans. Now, you say, okay, well, yeah, I only lost $10,580 on interest, but then also remember, you have also lost all the opportunity costs on that interest. And so, you know, this is actually, it's, in my opinion, a step up from leasing, but it's, you know, probably the worst alternative between saving or a whole life plan. So if we save and pay, assuming 3.5% interest, which I think is a pretty considerate amount, considering the low interest environment rates and the fact that you're not, if you're saving for a car that you're going to buy in 5 years, you're not going to, you know, put that in a place that's going to have risk. But basically what I did here is I assumed that, instead of buying that car, you just took the money and invested it. And this essentially over the 20 years, this is what you would have earned if you would have put it somewhere earning 3.5% interest. So your total opportunity cost that you lost was $46,201. Okay, that was the opportunity cost that you lost. So what's a different strategy? What if we use the whole life policy? Well, first of all, the first thing that you have to remember is that in order to make this work, you have to get your plan set up, right? You can't just start it from scratch. If you're going to start a business, you're going to have to put some money into that business, right? If you're going to start a bank, you got to have some assets ahead of time. So in order to make this happen, we have to make sure that we set up our bank. And so basically what I did here, and I'll show you the illustration here in a second, but basically what I did is I took a 33-year-old male and I had him put $5,000 a year into a participating whole life plan for 7 years, okay? And in this particular example, so that he put a total of $35,000 into this policy. At the end of 7 years, I actually stopped the premium payments and started taking out loans. While I'm taking out loans, remember you're going to pay yourself back, so I had to make the same loan payments as if you would have went down to the bank and took that out for a car. Well, what happens is after 4 cars, my cash value in the plan is $87,553. Now you might be saying, well, yeah, Seth, but it took $3,500 or $35,000 to start it up. Then you paid, $86,664 to pay off the loans. So, that's not really a true net. Well, what I do is I subtract out, what I paid to get it started, what I paid in loan payments, and then I subtract that out of the money I received, which was $80,000 plus the cash value of $87,000. And so what it nets out is actually $45,889. And so using this example, I actually come out with funding the cars, I gain $45,889. And I'll show you what this looks like in an illustration here. So up on the screen, I have this already set up, and I want to show you what I'm talking about as far as taking out the loans in the policy and paying them back. So here I have the input type on my illustration as input premium for max cash value accumulation. I have my loans and withdrawals already entered, but what I want to show you is I want to show you what the illustration looks like so that you have an understanding about what I'm talking about here. So here you can see I have my guaranteed and my non-guaranteed values. I have a 33-year-old. I'm putting $5,000 into a max funded whole life policy, so that's going to be.
All right, everyone. I want to thank everyone for their patience. Seth's line was disconnected, so we are trying to get him back on here. We're working on that. Yeah, everybody just hang tight. If you do have to jump off, I see there's a couple of you that have to leave. We are going to be recording this, so we'll kind of cut out the middle and send it to you. Again, I appreciate everyone for your patience while we're getting this back up. Thank you. I have been letting everybody know that your phone did get disconnected, so we can start right back where you left off.
Yeah, I apologize. I don't know what happened there. Where did it cut out at?
It cut out before you started going into Ensmark.
Okay.
So you were a few slides before that, just getting into kind of going into some of the specifics.
Okay. Then I'll take it from there. Again, so when they're looking at the whole life and they're saying, yeah, but with the whole life strategy, you actually put $35,000 into the plan ahead of time. So what if I did that into a similar investment? And what I can do is I actually have a tool, and Premier can help you with this as well. And what I can do is I can actually run a comparison where I'm actually going to compare how the whole life plan compares to a financial alternative. And so in this particular example, I used a CD that earns 3.5%. And a client might say, well, yeah, that's fine, but I can get better than 3.5%. And what I say is, yeah, you can, but you're not going to put money into a stock market or something that's going to have more risk where you're going to take it out in 5 years to, buy a car. Remember, we're using this to buy a car. So you're going to go put it in the bank. You'll probably put it just in a savings account. You probably won't even put it in a CD, but hypothetically, let's say you put it in a CD and get 3.5%, which you're not going to be able to. But what InSmart does is it actually does a great job of comparing the CD alternative to the whole life, and I'll show you what I mean here. Basically, the same thing's happening. We're putting $5,000 into the CD, $5,000 into the whole life, taking the same amount of loans, repaying the loans. You know, in the CD, technically, you would be withdrawing it, but it's doing the math for a comparative reasons. But at the end of those 20 years, what you can see is that down here, your CD is going to be $66,008, right? And the whole life actually has $87,553. So comparing apples to apples comparison, you can see that the whole life is going to be better. It has almost $20,000 more of cash in it. And if you actually wanted to compare to see what you would have to get to match it, over the course of it, you would actually have to earn a 5.98% return in order to match the cash value of the whole life plan to fund these cars. Again, where are you going to get 5.98, which is liquid enough and doesn't have any risk that you're going to be able to access it every 5 years to pay for a car and then fund it to get it back? And the reality is that even a CD you might not. Most people are just going to go put it in a savings account where they're not even going to get that. So this just shows how the whole life actually compares to the CD or an alternative where you actually save up and then pay So out of all the options, whole life comes out on top. And you know, you're going to have to get a pretty aggressive return in order to get it. So now what I want to do is just kind of go through a series of questions that I like to ask the client, and when I'm really positioning whole life to them as an alternative. You know, this isn't really that complex of a selling system. It's just a series of questions that by asking them, you can really position whole life favorably. You know, the first one is, what do you like about your current strategy? Typically here, what you're going to get as responses, if they have one, is that it's automated, meaning that, well, I like it because it just comes out of my check, right? You're going to get that. You might get something about, you know, they do like it being tax deferred, so they might like that. You know, it's going to vary, but, you know, just ask them what they currently like about their current strategy. The next question that I'm going to ask is, what do you not like about your current strategy? Typically, what you're going to get here is something that deals with risk, right? They didn't like it in 2008 when their cash value was going up and down. They don't like the risk. They don't like the uncertainty. The other thing, if you educate them properly, that they're not going to like is they're not going to like the taxes, right? When you have a tax-deferred account, all you're doing is postponing the taxes until a later time. And when you help them realize that and what they're actually going to end up paying in taxes, taxes is going to be something that they don't like as well. The next thing that I'm going to do is I'm going to rank their financial goals, right? Life insurance is not going to be the top one. Their top goals might be paying off debt. It might be, you know, buying a car. Might be saving for retirement, college funding, whatever the case might be. I want to know how they rank in importance. If their number one debt or number one objective is to pay off debt, then maybe what you need to do is actually write term insurance until they get their debt under control, maybe pay off some credit cards, things of that nature. Help them that way you're going to free up more money and put it into, you know, a whole life plan. Because I'm a firm believer, you know, if somebody is carrying credit card debt of 20%, where they're getting charged 20%, it makes sense to pay that off first, then free up that money and put it into something like this, because there's no point in getting an internal rate of return 5% when you're paying somebody 20 on the other end. So make sure you rank their financial goals, get a little bit more familiar with what they're doing, so you can better help them. You know, and then find out, you know, really what are their expectations. I always tell people, whole life insurance, universal life insurance, is not a get-rich-quick scheme. It's steady, consistent growth. It works better the longer you have it. So if they're having unrealistic expectations over the next 3 to 5 years, you know, whole life might not be the best solution. But I'm going to ask these questions just so I have a feeling for what they want. And then I tell them, you know, I show clients how they might be able to achieve their financial goals by eliminating 2 of the 3 risks that will prevent them from achieving these goals. And I'll show you these here in a moment. And I try to use as many aspects of their current strategy that they like and eliminate the qualities that they dislike. If I can do this with you, what concerns do you have about working with me? And so that's how I'm setting it up. That's how I'm getting it. And now I'm going to prove it to them what I do. The first thing that I would do is kind of help them understand the flow of money. And I tell them that up on the screen, this is their income. Okay, this circle represents their income. Some people's incomes are going to be bigger. Some people's are going to be less. But the thing that you have to realize is that this is not a stream of income. I want you to consider your income over the course of your lifetime. You know, if you're talking to a 35-year-old male or a 35-year-old couple that has a household income of $100,000, if they don't ever get a raise, by the time they're 65, $3 million will have passed through their hands. And if you ask them, would they look at that check for $3 million differently than that biweekly paycheck they get for their company? And of course they laugh. They say, yeah, but you know, they don't realize that how much their life is worth. And so I have to help them kind of understand what their economic life value is here, and that they actually will end up making a lot of money over the course of their lifetime. The next thing that I'm going to show them is that really out of all your income, it's basically going to go to 4 places. The first place is, and that's the purple slice up on the screen, is going to be taxes. Taxes is pretty easy for most people. Most W-2 employees, that comes out of their check. It's all done. It's all great. Life goes on. You live with whatever's left. Then most people have debt. Obviously, we're going to show them how life insurance might be a better alternative to debt. But then, you know, most people are going to pay the bank their mortgage, their car, credit card debt, whatever the case might be. That red piece of the pie goes to debt. After that, most of our money actually goes to lifestyle, right? We got to have those $5 coffees. We got to go out to eat several times a week. So a lot of it's going to go to lifestyle. And as I mentioned earlier, one area where a lot of people make the mistake when selling life insurance is they try to get the premium money out of that lifestyle piece of the pie. But people don't like to give up their vacations. Their life's a luxury, and so that's why term insurance is most often sold. But what I tell people is that with life insurance, what we're going to be able to do is we're going to be able to reduce the amount of taxes, and we're going to be able to reduce the amount of debt. And by doing so, we're going to naturally if we reduce the amount of debt and we reduce the amount of taxes, what we've naturally done here is we've naturally increased our savings and investments. And that's what life insurance is all about, and that's what we're going to talk about with you today, Mr. Client. So once I do that, I say now, if you were going to design your perfect plan to help you achieve your financial goal, because remember, now we have a list of their financial goals. So I'm going to ask them, if you had to design your perfect plan, what would it look like? I'm going to ask you some questions. You answer them. Would you want to have tax-deferred growth? Yes, of course. That's better than taxable growth, right? Do you want tax-free distribution opposed to tax-deferred distribution or taxable distribution? Yes, I want tax-free distribution. Do you want competitive growth opportunities? Well, yes, I want competitive growth opportunities. Do you want high contribution amounts, meaning that if you're talking with a high-income individual that maybe doesn't qualify for a Roth IRA or they're maxing out their 401k, do you want something that has high contribution amounts? Yeah, that sounds good. I don't want to be limited on how much I can put into it. Do you want additional benefits? What I mean by additional benefits, do you want the ability to maybe access some little bit of if you go into a nursing home, do you want a little bit of protection there? There I'm talking about the accelerated rider on it. Do you want some disability protection, maybe with the waiver of premium that you add to the policy? Do you want a little bit of protection from creditors? I'll always check what your state allows for protection from creditors, both in the death benefit and cash value with a life insurance plan, because that's a huge advantage to life insurance and just one of the additional benefits. So, I'm kind of talking about the accelerated rider. I'm kind of talking if I add the waiver, that's an additional benefit. and then what's protected from creditors. Those are going to be the three benefits that I'm kind of talking to. Do you want collateral opportunities, meaning that you can use it as collateral when going out and securing a loan? Do you want a safe harbor, meaning you want a place that's not exposed to a lot of risk, that's going to have guarantees? Do you want a no-loss provision? Again, something that has guarantees where if you put money into it, you're not going to lose money unless you take it out. It's going to grow every year. Do you want a guaranteed loan option, meaning that if you want to take a loan against your money, you can. And if you do have that option, do you want it to have unstructured or structured loan payments? A lot of vehicles might let you take a loan, but you got to pay it back by their rules. Would you rather pay them back by their rules or your own rules? And of course, you'd want it unstructured. Do you want liquidity, use, and control? Meaning, do you want, if you have to access this money early, even though this is designed for retirement, if you have to access it early, do you want that ability? Do you want to be in control, or do you want the government to be in control? Who do you want in control? So yes, they want liquidity, use, and control. Do you want a death benefit on top of that? Yeah, sure. If you can put a death benefit on top of it, that would be great. Do you want deductible contributions? They are going to say yes. So let's compare it to what they might be doing. Here is what they want, is they answered yes to all those questions. If you look at a 401k, you know, we don't get all of them. Yeah, we get the tax-deferred growth. We don't get tax-free distribution. We get competitive returns. We don't have high contributions. There is a limit on a contribution. We don't get any additional benefits. You can use it as collateral. We lose that safe harbor. There aren't no loss provisions. Sometimes you can take loans, but when you have to repay those loans, you got to pay them back at their rules. There's really not liquidity, use, and control, because if you access it before 59 and a half, you got to pay penalties. Deductible contributions, yes. Death benefit, no. So that's how a 401k compares. Well, let's compare it to something a little bit more conservative. Tax-deferred growth, no. Tax-free distribution, yes. Competitive returns, not really. High contribution amounts, yes. Additional benefits, no. Collateral opportunities, yes. Safe harbor, yes. No loss provision, yes. Guaranteed loans, no. Unstructured loan payments, no. Liquidity, no. Deductible contributions, no. Death benefit, no. So this is how, with the two of them that they're probably doing, and how they compare to what they're looking for and what actually happens. Now let's look at cash value life insurance. As you can see, we get all these benefits with cash value life insurance. The only one we lose is the deductible contributions, right? Because we're paying it with after-tax dollars. That way we can have tax-free distribution. And so what they're currently doing doesn't match up with what they want to do. What actually matches up the best with it, which gets the most of it, is actually life insurance. And that's what a lot of people don't realize, they don't realize the power of life insurance for doing that. And so remember, I told them that I can show them how I can protect them from the 3 risks that will prevent them from achieving their goal. The first risk is they don't get started. I can't do anything for them for that. They have to take initiative. If they're not wanting to get started, they're not going to achieve their financial goal. Second one is lose money. With the guarantees in whole life, I can show them how they're not going, I can guarantee they're not going to lose money, right? In any of those examples, even the guaranteed values were higher than the premiums that I paid in at some point in time. So I can show them how they're not going to lose money. Number 3, they die prematurely. And whether you like it or not, that's a risk, a major risk from you achieving your financial goal. There's only one tool that effectively protects against that risk, and it's life insurance. And if you can show me some other tool that does it as effective as life insurance, by all means, I'll look at it. But I've never seen a tool that protects against the risk of premature death as well as life insurance. And so remember, smart money, we were looking for guarantees, growth, liquidity, tax efficiency, death benefit, and life insurance provides all of that. Bottom line, if I can provide you with all these qualities, do you care which financial vehicle we use? Great. I'd like to ask you a few more questions and then set up a meeting and go over a couple of options. That's how I'm bringing it up and how I'm presenting it to the clients. Jason, that concludes my presentation, and I'll go ahead and turn it over to you. If there's any questions that I need to ask, I'd be more than willing, but that's where we're at.
Excellent. Thank you, Seth. We really appreciate that. That was a really great run-through of how our agents can use that in the field, so perfect. Just a few things that I would like to go over with you here before we end the show. Just a few things that we're doing here that we feel are very important. When you call Premier, we're more than just product. I mean, we do have a lot of great relationships with Assurity and many other companies out there, but we also offer a lot of things here that you just can't get everywhere. The first one is we do have full underwriting support desk, so we work very hard with fast turnaround times for case design, back office support from start to finish. Where that really comes in value for you is that it's really important to know how your clients will rate as far as their health. Make sure that we're matching them up with the right premium when we get started. That's going to help you with your placement ratio, also help you with that relationship with the client, which is ever so important to nurture. We also have cutting-edge technology, so we have quote engines, e-apps, online contracting, an extremely unique system called X-Ray that can help you with a lot of different areas and much, much more. So give us a call. We have a great way of helping you figure out where things should go, makes your life streamlined through these different systems that we set up. But the most important thing we have here for you is your experienced marketing staff. We do couple you up with a team here, and we work hard to help custom tailor your approach and get you ready to sell by introducing fresh sales concepts, tools, resources. We got a lot of things that we're doing here, so give us a call. We definitely look forward to working with you. Well, that's all we have for you today, so I do appreciate your time. Again, thank you. I really hope that, if you have any questions, you give us a call. We'll go through everything with you. Number here on the bottom of the screen, 800-365-8208. Just ask for your life team. If you had any questions that were unanswered during the show, we will have somebody reach back out to you. Even if we did answer them, we'll still get back out to you just to make sure that, it was clear enough for you. So, again, everyone, thank you for your time. Seth, thank you for joining us today, and everyone enjoy the rest of your day. Thank you.